So learning objectives, I can create a budget by understanding wants and needs by using money savings tips. So wants versus needs. What is the difference between a want and a need? Want is something just nice to have. Need is something we have to survive. Wants such as phone, eating out, gym membership, haircuts, entertainment. So a good thing to do is to for your bank, download your bank's app on your cell phone. And it's a good way to track your spending so you can figure out how much you're spending on all these areas and anything that's a want. And those are things that you could cut potentially certain amounts. So you can still spend a certain amount on all these things, but you could cut the amount you spend on each just to find savings in your budget. So I recommend tracking your spending on these things and then figuring out what you can cut. You can still budget you can still budget a certain amount each month for these things, but there's always ways you can cut down on spending on these things. Then needs. So these needs here, it's very hard to cut down on spending on needs. So so one of the things you have to do is make sure you find enough income streams to pay for these needs. So you might want to make, you might want to do side hustles if it's finding contracts on the side, if it's finding a way to make income passively, maybe through investing, maybe through advertising products on your blog, on your social media website through affiliate marketing, just finding ways to make extra money to pay for your needs. So needs like clothing, rent, gas, emergency saving, car insurance, school books, groceries, car maintenance, unexpected expenses. Finding other income streams is a good way to pay for these needs because you can't really cut spending on a lot of these things. But the caveat here, clothing, you could cut spending on clothing through buying clothing secondhand. So going to stores like Salvation Army, Talese, Value Village, you can cut your spending on clothing. So that's a good option. Rent's very hard to cut spending on. Gas is very hard to cut spending on as well. Emergency saving, you want to make sure you're saving for emergencies if you can. Car insurance, it's very hard to find a lower rate, but you may compare across the board and see if there's a cheaper car insurance place. School books, you could get used school books. You could, if it's not mandatory, you could just forego getting a school book and not get it. So that's this sometimes not mandatory. You may not have to get it. Groceries, that's mandatory. Just make sure you find deals. So find ways to buy cheaper groceries. Car maintenance, maybe find a mechanic that's cheaper. So ask around, ask your friends and family and figure out how much they're paying for their car maintenance and see if there's deals out there. See if you can pay less for car maintenance. So yeah, there's ways to cut down on spending on that. So want or need. So what's a want or need? Like what it, in the picture here of a Nintendo Switch, is that a want or a need? So that is a want, correct. So you can cut down on spending on stuff like that because it's a want. So soda right here, is that a want or a need? So soda is a want. That's correct. You can cut down on spending on soda. Candy is a want or need. It is a want. That's correct. Candy is a want. Uh, Candy is a want. That's correct. Water is it a want or a need? Yes, correct. It is a need. So water is very integral to our health. Very well done. Fixed versus variable expenses. So when setting up a budget, there are two types of expenses. Fixed expenses, expenses that come every month, no matter what. Variable expenses, expenses that can change from month to month. So budgeting when setting up a budget is good to determine what your fixed expenses are and what your variable expenses are. This will help you understand how much you have to spend on fixed expenses, no matter what each month, and how much money you have left over for variable expenses. So fixed costs remain the same regardless of sales. Variable costs change based on your sales activity. So going to the movies, is that a variable expense per month or fixed expense per month? So correct, it is a variable expense. It goes up and down. You're not really budgeting for that. Eating out, is that a fixed expense or variable expense? Variable expense, exactly. It changes from month to month. Yeah. Car insurance, is that a fixed expense or variable expense? Correct, it is a fixed expense. Well done. Electric bill, is that a fixed expense, variable expense, or can be both debatable? So yeah, it can be both because sometimes you will use more electricity than other months. Maybe you use a little more electricity in one month than the next for various reasons. Cable bill, is that a fixed expense or variable expense? Fixed expense, well done. Gross versus net pay. Both are considered income. Gross income is the total amount earned before deductions. Net income is your take-home pay. So gross income is your income before deductions. So once you see on your pay stub, you might see Jeopardy here. So I'll put names here. So here, so Abby here, Kala here, and then also Nicole, Samir, and then Shane Tareem. So let's start this here. So this is on a lot of the budgeting. So what is the primary purpose of financial budgeting? So Abby and Tareem and Kala had some good responses here. So it's plan company expenses and revenues for specific time periods. So I'll give you all a point for this. Well done. So explain the difference between financial budgeting and financial forecasting. So yeah, good response with Tareem, Kala, and Nicole and Abby here. So yeah, financial budgeting sets the company's financial direction, while financial forecasting estimates future income or revenue. So well done. So Abby, Nicole, Kala, Tareem. Yeah. Abby, Kala, Nicole, Tareem. Well done. So next one is what are the key components included in a financial budget? So Nicole, variable and fixed expenditures and financial goals. Kala, saving fixed variable expenses, income debt. Shane, income expenses, fixed and variable wants, emergency funds. Well done. So yeah, predicted revenue, fixed expenses, variable costs, and capital expenditures. So yeah, Tareem, Shane, Kala, Nicole. Well done. So name and briefly describe. So let's skip this here. Then why is financial forecasting important and how does it differ from budgeting? Tareem, break to future financial incomes. Abby looks into future finances and meet goals beginning here more now. Kala leads to more stable cash flow, growing the business. Yeah. Well done. Yeah, so analyze trends and future costs, providing a basis for adapting plans, unlike budgeting and focus on future facing assessments. Well done. So what is the main characteristic of zero-based budgeting? Nicole, equilibrium between income and expense. Yeah, so yeah, that's true. So yeah. So all items start at $0 before reallocating. So it does lead to equilibrium. Yeah, so every expense regardless of spending is justified. So I'll give Tareen that too as well. Hold on. So let's skip this here. Next one. Um, skip this here. Skip this here. Then zero-based budgeting is a great way to budget. And skip this here. And then list 3 steps involved in the financial budgeting process. Tareem, track income, list expenses, categorize expenses. Well done. So yeah, establish immediate targets, just develop a detailed budget, finalize employee compensation plans. Call this is set the goals, calculate all variables and just. Yeah, great answers here. That's really good. Tareem and Kala here. Why is monitoring progress throughout the budgeted period important? Abby says know where expenses are going and how to modify budgeting. Yes, correct. Success performance against goals and adapt to plans needed. Well done. So, so let's skip this here. And how can financial forecasting help during unforeseen events like the COVID-19 pandemic? So Dreams has helped make informed decisions for the businesses. Abby says knowing how to invest, fast producers. Yes. So yeah, it enables executives to rework budgets rapidly to account for safety concerns, major loss, and potential reputation damage. Yeah. So what you both of you said was good. So who is typically responsible for ensuring that the budget is followed? Dream says budget managers. Yeah. So I'll give Tareem that. Good job. What role do department managers play in the financial budgeting process? Dream says create and manage their department's budget. Yeah. So provide information through the process, reporting revenue contributions and expenses. Well done. So how does the finance and accounting team contribute to the financial budgeting process? Tareem manage account receivables, payable, and payroll. Yes. So yeah, manage accounts or create reports and provide input for top level budgets. Great job. So who is directly accountable to the board of directors in the financial budgeting process? So Tareem, corporate executive, CEO. Yes, so corporate executives, including chief financial officer, CFO. So yeah, so all of them. Yeah. So well done. Why might a company employ a committee of multiple budget owners and what challenges may arise from this approach? So Abby says, so we see different aspects of the company, problem of allocation of budget disputes. Yes, it's more democratic but less efficient, leading to indecisiveness and infighting. Yeah, good job. So what common problem do finance teams face related to data and the financial budgeting process? Tareem says data inaccuracy. Yeah, just inaccuracy and also disconnected data because there's not a lot of data sharing, which becomes a problem. How do manual processes affect financial budgeting? Tareem increased errors dealing with outdated data. They're slow, labor intensive, and lack the version control and data integrity of automated tools. Why are time consuming data collection and input automated in financial budgeting? So obviously, to make the process faster, more efficient, to reduce errors and speed up the aggregation process. Well done, well done. Tareem to enhance efficiency. That's correct too. Good job. And then how does skip this here. So what are the key benefits of using data driven platforms in financial budgeting? Enable companies to control their cash flow better. They offer real-time tracking of KPIs, key performance indicators, enable for 7 years straight. However, Enron's success turned out to have involved a huge scam. 2001, Enron was exposed to having overstated earnings and being in deep debts, leading to its bankruptcy, which was considered the largest corporate bankruptcy at the time. In addition, Enron was also cited as its biggest audit failure due to its fraudulent accounting practices. Here are the top executives of Enron Corporation. Enron was formed in 1985 by Kenneth Lay after merging Houston Natural Gas and Internorth, two natural gas pipeline companies. At its peak, Enron was the sixth largest energy company in the world. 7 years later, Lay hired Jeffrey Skilling to help him operate and expand the business. The company pursued a bold, broadening strategy whereby it bought and built all sorts of assets around the globe, including electric generating plant, pulp and paper mills, water plants, broadband services. However, Enron used so much debt, which it took on using complex corporate structures and partnerships to cover for the cost of its business expansion. Skilling developed a staff of executives that were able to hide billions of dollars in debt from failed deals and projects by the use of accounting loopholes, special purpose entities, and poor financial reporting. Chief Financial Officer Andrew Fastow and other executives misled Enron's board of directors and audit committee on high risk accounting practices. They also enticed Arthur Andersen, one of the 5 largest audit and accountancy partnerships in the world at the time, to ignore the issues. In 1991, when Jeff Skilling joined Enron, rather than using historical cost accounting like everyone else, he insisted that Enron used a form of accounting called mark-to-market accounting. So mark-to-market accounting, they could assign a value. So with mark-to-market accounting, they could record the revenue before it's received. So that becomes a problem. That becomes a big problem because the cash hasn't come into the company yet, but they're observing it as revenue. And they did this a lot. And then it turned out that they never received anything. They never received a lot of it. And the revenue was substantially lower than what was reported because much of the revenue they reported was not received ever. And it was just made up. So that became a big problem. So because much of what happened at Enron can be traced to the decision to use mark-to-market accounting, so it's important to understand the difference between conventional accounting and mark-to-market accounting. So you want to make sure that this ties back to the investing. You want to make sure that you invest in companies that have high integrity and they're not lying on their accounting. You want to make sure that they're not using mark-to-market accounting. They're using conventional accounting. So that's a very important thing to look for. Also, a company may look perfect on paper in a lot of cases, but it turns out that they are a fraud because there's a lot of things that they don't report on paper. There's a lot of things that are hidden. So that's why diversification is key in investing because you can avoid having all your eggs in one basket. You don't want to invest all your money in one company and the company turns out to be a fraud. So you want to invest in many different companies and that'll protect you if one turns out to be a scam. Suppose you have a contract in which cash is going to come in the door, say a 15-year contract, but you say the value of the contract is X dollars today. So you book that X dollars in your income statement today, although the cash comes in over the life of the contract. That's what they did. So that's exactly what they did. So the if they were going to make, let's say their contract was $1 billion over 15 years, they would record $1 billion today as their revenue for this year. And that becomes a big problem because much of the money is deferred over the 15-year span. It's not all received in 1 year. So that became a big problem because the because they weren't receiving it all in 1 year. Moreover, there were a couple of dangerous things in mark-to-market accounting. One is that although the earning revenues are booked up front, the cash still comes in the door over the life of the contract. So over time, there are bigger and bigger differences between the earnings that everyone was showing us income statement and the actual cash the business was making. Another issue is that because all the earnings from the contract have been booked, so only the changes in the value of that contract are going to be booked, not any earnings that the contract may produce in any given year. Therefore, each year starts at zero and you don't have any recurring earnings on which to build. In the 1990s, corporate America rewards companies for booking consistent 15 to 20% growth in earnings. This is how the companies got a big high stock price. Being ambitious, Enron wanted to have a very high stock price. So it kept posting record profits from 387 million in 1993 to 453 million in 1994 to 520 million in 1995, attracting many investors' interest in stocks. Enron's stock price tripled from 20 to $60 per share in mid 1990 to late 1995, and by the middle of 2000s, the share price was over $80. Clearest evidence of dubious practices in the report concerns the way the top executives were rewarded, even as the company was hurtling towards disaster. So in 2001, Bethany McLean raised a lot of questions about Enron's high stock value and earning revenues. She wrote an article called Is Enron Overpriced? And that led to the book, The Smartest Guys in the Room, focused on Enron's rise and fall. Amazing book that Bethany McLean and also the other co-author wrote. Amazing book. Yeah. She even pointed out many strange transactions, not unreliable cash flow, as well as Enron's debts. Enron tried to dismiss the kind of commotion from this article. However, as time passed, there were more and more concerns about Enron's complicated structure, finance, and the complexity of business, resulting in a decline of investors' confidence. Enron's stock started to plummet. In August 2001, Jeff Skilling abruptly resigned his job. On December 2nd, 2001, Enron declared bankruptcy. With its 63.4 billion in assets, Enron made it the largest corporate bankruptcy in U.S. history at the time. Furthermore, Enron was exposed to have $38 billion in debt, but only $12 billion showed up in its balance sheet. As a result, the loss sustained by investors exceeded $70 billion. So they hid much of that debt in these things called special purpose entities. They hid it so it wouldn't show up for investors, which was a big problem. It showed that they weren't transparent. Moreover, it also costs both trustees and employees upwards of $2 billion from the investments, savings, and pension plans. 22 Enron executives and partners were found guilty of criminal charges for their roles in Enron's collapse.
Arthur Anderson was found guilty